Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita, with me is Snehi Shah, and let's quickly look at what the Nifty is up to. A third of a percent lower in terms of the cut. It's about 75 odd points, so not much. And honestly, we started on a tough note. So in fact, now we've seen a very, very range-bound market, but it's not been particularly choppy. So that's the positive of all of this that's playing out. In terms of the high of the day, you can see 25,694, but for a large part, it's traded in a very, very tight band. It's traded between 25,500 and 25,600, with 25,620 odd being at the higher end of the band, which is what we're currently trading at. In terms of stocks and within that Nifty 50 universe, you're seeing, of course, some movers. Wipro is down 8%. Reliance Industries down 3%, soft set of numbers. Tata Motors PV is down 2 to 2.5 odd percent. Eternal down nearly 2.25% as well. And you have ICICI Bank, which is down 2% as well in trade. So you're seeing softness on those counters. Again, earnings dominant. Let's look at what Tech Mahindra is doing. Nearly 4% higher on a Tech Mahindra. You're seeing decent. You're seeing a very, very flattish move where HDFC Bank is concerned versus what some of the other earnings candidates within that Nifty pack seem to be doing. So 0.25% lower on HDFC Bank, and this is after the kind of move we've already seen on a month-to-date basis where HDFC Bank is concerned. Some of the other movers, you look at an Interglobe, it's up 4% in trade, so doing well for itself. A Kotak Mahindra Bank up 2.5%. Bajaj Finance up 2%, Maruti up, Shriram Finance up, ITC Limited for a change up 1.5% as well. So you're seeing some moves around those counters. The advanced decline on the Nifty 50 looking tough, looking weak. So that, yes, that is a cause of concern as well. But it's just the heavyweights. Reliance Industries alone pulling the index down by 68 points. ICICI Bank plus Reliance pulling the index down by 111 points. Throw in Wipro, that's 125 points. So that's where all of the pressure is coming from. Three stocks contributing negative 125 points on the index. So you want to keep your eye out on that part of the market as well, that it's very concentrated. In terms of stocks standing out, the Nifty FMCG index is up nearly 1%. Outside of that, auto up around 0.25%. So is maybe consumption, if I can call it that. So Nifty consumption. Nifty Realty is the real catastrophe. It's down 2% in trade. So really seeing pressure. Among the broader end of the market also, you're seeing pressure. 0.4% lower on the Nifty mid cap index, but 1% lower on the Nifty small cap. So the broader end is where a bulk of the pressure is coming from. But there are plenty of stocks on our radar this afternoon. Let's go across. Rabinder here with a list of those stocks you want to keep on your radar on the back of corporate announcements which are moving. Rabinder, start off.
Well, yes, most of the stock is in focus on the back of the quarterly earnings. So firstly, let's start with RBL Bank, where RBL Bank is under pressure on the back of their weak Q3 FY26 earning. And in this quarter, company's net interest income saw an uptick of 7% on a sequential basis, but company's gross GNP ratio has declined to 44 basis points on a sequential basis. So back on the weak set of number, RBL Bank is under pressure. CG Power is in focus on the back of the order win when company has foray into a data center segment, and company has win order of rupees 900 crore from Tallgrass for the power transformer. So back of this, CG Power is also in focus. Jindal is another stock that is focused, where the stock is up more than 15% on a intraday basis, where on Friday company reported a weak set of number on a year-on-year basis, where revenue saw a downtick of 6.2% on a yearly basis, and PAT was declined by 49% year-on-year basis. But if we look at the number of the company on a sequential basis, then company's number has improved on a sequential basis, and the company's order book is at a record high in terms of volume. So back of this, stock is up more than 15% on a intraday basis. L&T Finance is in focus, where stock has recovered from the day's lows, and stock has recovered more than 6% from the day's low to trade in green, where company total banks Company's total income saw an uptick of 12% on a year-on-year basis and 6% on a sequential basis, and NIMS has also improved by 19 basis points on a sequential basis. So back of the good set of number, L&T Finance is also in focus. Hindustan Zinc is in action where silver at MCX hit a record high, crosses 3 lakh per kg ton for the first time ever, and HSBC has come out with a note on the metal space, and they have upgraded the stock to buy from the hold and hike target price to rupees 750 as compared to earlier target price rupees 520. So back of this, Hindustan Zinc is also in focus. And lastly, Punjab National Bank is under pressure where company reported a Q3 FY26 number, and after that company's stock shown a sharp decline of approximately 5%, where companies reported a weak set of number in Q3 FY26, where bank's provision has increased from 643 crore to 1150 crore on a sequential basis, and net interest income has fallen down by from 4.5% on a year-on-year basis. So back of the weak set of number, PNB is also in focus.
Ravinder, thanks so much for taking us through that. So yes, PNB, the one to come out with its numbers latest right now, seeing a negative move on the charts right now on the back of slightly weaker than expected numbers and the hike in provisioning that they have undertaken. But shifting focus and talking about the top Nifty loser today, that's Wipro, reported an inline set of numbers for the quarter gone by. PAT and EBIT missed street estimates. The IT major reported a dip in profits on the back of that one-time labor code impact that has uniformly, can't say uniformly because the impact is different, the quantum is different, but yes, everybody has seen the impact of this one-time labor code across the IT companies. Let's understand what the brokerages are saying when it comes to their earnings. The most important one right now is Morgan Stanley, because they've downgraded the stock to an underweight rating and slashed the target price to 242 from 270, and that's one of the reasons why the stock is majorly under pressure today. Across the board, the consensus is that the rating has been held, but the target price has been trimmed. That is the case with CLSA, wherein they've maintained their hold rating but target price has been slashed. Similarly for Citi, maintained sell but target price cut, and Goldman Sachs too has maintained its sell rating but has slashed the target price. For Motilal Oswal, they've maintained a neutral rating, target price has been maintained at 275. Nomura has maintained a buy rating with a target price at 290. It's actually Investec that's standing out on the other side of the spectrum, because it's maintained the buy rating, but the target price has been hiked to 294 from 285. This amid a backdrop where most of the brokerages are cutting the target price. So Investec is the one that stands out for us. But yes, it's Morgan Stanley that's downgraded the stock to an underweight and cut the target price too. That, along with the growth guidance that the management has given for the fourth quarter between 0 and 2% constant currency revenue growth, that is also slightly disappointing in terms of how the street is taking it, and that's the reason why Wipro is under pressure. In fact, we also caught up with the management to get a better outlook on the numbers and the outlook going ahead. Let's go across and listen.
I think the themes of vendor consolidation, clearly continues, and that's something that we'll stay focused on. There are a lot of opportunities for us on the run and operate aspect of it, and most of this now are going to be AI first, AI led. Discretionary spend is something that we are watching, and January is a time when many of our clients actually finalize their budgets for the year ahead. I think that's another one that we are staying focused on.
We've improved profitability in our fixed price programs. We've improved our utilization. We've optimized on our SG&A. Our acquired entities have also rallied and done a good job. So I think it's overall credit to the whole team for improving margins consistently. This is despite the weaker revenue environment and a very competitive landscape. So we're quite proud of what we have accomplished thus far. Forex also helped. The rupee depreciation also played into our operating margins in a quarter-on-quarter basis.
Okay, so that's the word coming in from the management of Wipro. The other stock that we're looking at today is JSW Infra. Let's pull up that stock and see if the stock is still as high as it was in the first half of the trading session. We'll have that stock up for you on the screen very soon. But yes, this stock is in focus on the back of healthy set of quarter 3 numbers, and also what the brokerage reaction has been to these numbers. Let's first understand what the quarter 3 fine print looks like. On a year-on-year basis, revenue is up 14%. Net profit is seen an uptick of 9%. EBITDA is also up 5% at 703 crores. It's the EBITDA margin that has seen a little bit of a shrinking at 49.9% compared to 52.9%. So a little bit of a cut over there. But two brokerage notes coming in on JSW Infra. The first one being Nuvama. They've maintained their buy rating with a target price of 360 rupees per share. They believe that there is steady growth across all the financial metrics. Their ports segment is doing very well. There's been ramp up in the logistics momentum, so that is also looking very good. And logistics is expected to emerge as a meaningful earnings contributor in the near future is something that they're saying. But more importantly, throwing the spotlight on the note coming in from Kotak Institutional Equities, wherein they've upgraded the stock to an add from a reduce and have also hiked the target price to 285 from 270. They believe that the company has reported an inline set of Q3 numbers. The growth is returning for the company. Logistics business has seen marked improvement and is progressing well on its inorganic growth plan. They're also saying that valuations have steeply corrected for this stock and it looks more attractive compared to its peers, its peer Adani Ports. So that is something that they're liking. And overall, they're saying they've increased the EPS estimates for the stock by 1 to 4% due to marginally higher port margin. So it's the ports, the logistic business that have done very well for JSW Infra, continues to be higher today. A 7% uptick coming in on that stock today, Harsh.
Okay, so JSW Infra absolutely flying in trade, 7% higher. The other one with the earnings impact is PNB. What we've seen is elevated credit cost. It seems that some chunk of that is because of some contingency provision which they've built up. I'll quickly look at those numbers, give you a sense. But that stock is down 4%. Again, on the back of numbers. We'll come straight to that, but let's go across to Rabinder. Polycab, it's upbeat in trade, mixed set of numbers for Q3. Margins actually came off. Company clocked highest ever quarterly revenue though. Brokerages seem to have a positive stance. In fact, Citi even upgraded its target price. And there's plenty of upside to those target prices, which Citi, Morgan Stanley, Goldman Sachs, all of them have given. Rabinder here with the number crunching.
Well, as Polycab reported a mixed set of number in Q3 FY26, where company's net revenue saw an uptick of 46% year-on-year basis, and company reported a highest ever quarterly revenue, which is driven by the strong execution in wires and cable segment and healthy growth in the FMEG business. But company's EBITDA margin saw a decline on the back of the delayed price transmission, and wires segment has outperformed cable during the quarter. Within the cable segment, institutional sales growth outpaced channel sales growth, and FMEG segment is also demonstrated continued momentum, recording a 17% year-on-year growth, and growth was led by the solar category. And EPC revenue also grew by 4% year-on-year basis. And management is also very optimistic for the future growth, where they say that the solar business is expected to continue its strong momentum in Q4 and on the coming years, and with a very positive outlook. And after that, the brokerages has also increased their target price, and some has upgraded the stock, where Nuvama has maintained the buy rating and hiked target price rupees 9,240 as compared to earlier target price rupees 9,070, and Avendus Spark has upgraded the stock to add from the reduced rating and hiked target price rupees 8,163 as compared to earlier target price rupees 6,957. And Citi and HSBC both also has hiked the target price, where HSBC has maintained the buy rating and hiked target price rupees 8,900. So back of the mixed set of number and positive management commentary and positive stance from the brokerages, Polycab is in focus, and the stock is up approximately 5% on an intraday basis.
Okay, that's on Polycab. Ravinder, thanks so much for taking us through that. So 4% uptick on Polycab and holding up really well for all the reasons that Ravinder just stated out. But we have Kunal who's joined us in the studio. Kunal, good afternoon. First up, before we get a chart check on some of these names that we've discussed, talk to us about where you're seeing the market. More importantly, look at the breadth of the market. It's absolutely battered and in favor of the declines right now. Where at all, if at all, are you seeing any strength today?
So, of course, I think there are two ways to look at the markets today. One is the 100-point cut on the Nifty. But the other way to look at it is that you've seen 3 or 4 major large cap names: Reliance, ICICI Bank, Wipro, HDFC Bank. I think these 4 stocks have actually contributed almost 75 to 85 to 90 odd points on the Nifty on the downside. And I think for the Nifty to hang around to this 100 odd point negative and to see a recovery of more than 150 points from the intraday lows, I think indicates that we are at a point where the markets are just more trying to absorb the kind of negativity in terms of large cap names. So, over the last 7-8 trading sessions odd, 1.5 odd week, we've seen so many large cap stocks being battered and bruised as such. And we've seen cuts of 5% to broad 10% for many of these large cap names. But the way the Nifty has been holding on to that 25,500 mark for the last 1 week, I think indicates that this could be a new support for the index over the very short term. So yes, the market breadth, etc., looks extremely dismal for the index. But look at the way large cap stocks have been behaving. But I think if you're looking at a day where the names like Reliance is down 2%, HDFC Bank, ICICI Bank, etc., are down by 3% or 1% approximately, then for the Nifty to close maybe 100, 120 points on the negative side, I think could be considered as a day where the markets have seen more strength rather than more weakness.
Okay. And Kunal, let's talk stock specific. On a day where Reliance, Wipro, some of the heavyweights, ICICI Bank, are all contributing massively to the kind of pressure that the Nifty is seeing. Give us a sense on what next with regard to, in terms of levels, with regard to a Reliance in particular, because it's the heaviest of the lot, and therefore, as long as there's pressure there, I'm not sure whether one can say that the index returns may be capped because of the kind of weightage it commands.
Well, absolutely, yes. Reliance, of course, commands the a higher weightage and more or less like a sentiment direction for the overall indices. But we've seen this many times, multiple times, that when a stock goes into a larger cap name goes into a correction after coming closer to the life highs, somewhere around the round figure mark for the stock prices, say a 10% broad correction from the previous swing highs, and round figure mark for these stocks is where you see the correction halting for the stocks. Now, for example, Reliance is coming very close to that 1400 levels. I think 1403 approximately is the low for the stock on an intraday basis. There might be a point, say, by tomorrow that the stock may breach on intraday basis a level of 1400 mark. But that, I believe, could probably be a point where the stock may start to look a little bit more attractive or lucrative in terms of the contra positioning. We've seen multiple times that option positions, they generally tend to reverse their stance at these strong psychological mark. So I think in that case, I would probably expect that maybe in the next couple of days, there could be a point where Reliance may start to look a lot more attractive in terms of a contra buy. So the major poison for the stock in the last maybe 2 or 3 weeks, that seems to be out. And I think there could be more like a residual correction which could happen to the stock price, but that could be an opportunity for a long-term trader.
How much, Kunal?
How much in the sense?
I mean, how much low? At what point do you buy?
See, if you ask me broadly, I think anything below 1400, say a 1390.95 could be a good point if the stock happens to reach to those levels.
Okay, from the world's most powerful boardroom in the Alps, ET now brings you India and the world in conversation. Join us at Davos 2026 with global leaders, CEOs and policy makers shaping the next economic cycle, from Sir Martin Sorrell on the future of capitalism to Anish Shah, Girish Tanti and Nadir Godrej on growth, energy and global supply chains. With voices from finance, technology, sustainability and the government, including Ashwini Vaishnav and Smriti Irani, stay tuned for exclusive conversations through the week. On that note, time for a very short break.
Welcome back, and we're joined by Anurag Gupta, partner Deloitte India, on this very special series that we're doing at 2:15 every day, between 2:15 and 2:30 rather, to talk about what the budget expectations for the Union Budget 2026 could be. Anurag, great having you. First, let me start off, and viewers, for context, today we're going to talk about the railway sector, and this has been a sector in terms of allocation, Anurag, where it has flattened at around 2.6 lakh crore. You believe that this time around there is enough merit in hiking that? And if so, how much of a hike would you expect within the budget for railways in particular?
Thanks. So I think we'll have to look at the trend which this government has adopted in last few budgets. So barring the last year where I think it was an issue of absorption capacity, the government has sent out a clear message that capital will not be a limitation anymore. And I do expect the accelerated capital allocation to continue this year by another 5 to anywhere between 5 to 20%. Uh, I think Indian Railway is on a very ambitious capital investment program, whether it to create new freight lines or to modernize its fleet. And the financial support through the budget, we expect it to continue this year as well.
Okay, Anurag, when you talk about financial support from the budget, are you expecting to see more capex? Are you expecting to see more announcement on the reforms front? Or are you expecting to hear more on the public-private partnership? Are you expecting anything along those lines?
Actually, my wish list to hear on all three fronts. Not one will solve the problem alone. See, at the end of the day, capital investment, the capacity has to be created ahead of demand. And in that context, reforms, execution certainty for the projects which are already in motion, improving the services portfolio of railways is equally important. So reforms is equally important on that front. It is also a reality that going forward, given the public service obligation and the kind of capital outlay which is required as per the National Rail Plan and Railway's own stated goals, private sector has to play a larger role. So greater PPPs, in fact, reform of railways PPP frameworks, and definitely greater reliance on InvITs and greater reliance on newer PPP structures is something we definitely would like to see in this budget.
Where would the spend thrust be, Anurag? Would it be on technology? How would the spend play out, in your opinion?
I think technology, civil infrastructure, and capital infrastructure will definitely have the larger portion. But I do expect major technology push, especially in the areas like safety, accelerating the Kavach implementation with greater outlay, bringing in greater execution certainty. I think a lot has been done there. A lot more needs to be done. So while the significant portion will be on the capital infrastructure, technology will definitely play its part, if not equal, but definitely will be a priority, as I expect in this budget.
So, Anurag, what quantum of capex is going to be realistically required to achieve all of these goals? Because we've spoken about a bunch of them, Kavach and tech being one of some of the important thrust areas. But talk to us about what could be a realistic number to expect here.
I would not like to put in a number. The wish list is actually as much as they can provide. Indian Railway has provided a long-term 10-year goal, wherein they have a clear investment program. Last year, I think the government provided in the range of 2.6 lakh crores. I do expect around 10 to 15% jump in this year. Having said that, the PPPs have to play a larger role, at least 10 to 20% to start with in the next immediate future. So I think the requirement is as much as it can. The railways demand is infinite in a country like India. A lot has been done. As I said, a lot more needs to be done. And while GBS, we expect to go from 2.6 to say 2.85 or 2.9, probably PPPs also have to go up and to share around 10 to 20% of the share of burden from a financial point of view.
What are the gaps, Anurag, that you're seeing from an industry standpoint? What are the gaps? What are the requirements that the industry needs ironed out from the government? And how much of that is actually playing out? Do you believe that there are larger gaps which need addressing, or the gaps are quickly getting filled up? Give us a sense of that.
If you look at railways and public sector privatized participation within railway sector, it's in India, it definitely has a lot of catching up to do. But at the same time, some of these projects are marquee projects. They are not done anywhere globally in the world. So whether it is coming in for bringing in private capital for new line capacity creation, or whether it is augmenting the asset monetization program which is there. Even private train operations. Indian Railway has tried a lot. They have learned a lot, and I think they have gone back to the drawing board in that context. We see some new PPP structures, as well as Indian Railway revisiting its own PPP and the participative policy from 2012, giving it a reshape and giving it a complete refresh this year. So in that context, I think the gap is not much large. Some of these projects are marquee projects, so having the initial inhibition as well as there is normal, and as well as there will be a lot of learning on the way. But I think hopefully we will be there. All the building blocks to move in the right direction are already in place from our view.
Okay. And also talk to us about what kind of policy support are you expecting to hear to improve the freight share and logistics competitiveness that we're seeing in railways compared to roadways right now?
So Indian Railways' traditional logistics positioning has been a supplier of rail services from terminal to terminal. I think what the industry wants is a door-to-door customized logistics solution provider. And in that context, Indian Railway has brought in a number of reforms, whether it is rationalizing the rate structure, whether it is bringing in greater certainty in terms of freight operations itself. However, a lot more needs to be done, whether it is partnership with the logistic service providers for providing first and last mile connectivity, fast tracking the Gati Shakti terminals program, as well as more innovative pricing structures like dynamic pricing or corridor-based pricing rather than a fixed distance-based pricing. Some of these reforms Indian Railway has already committed to in National Rail Plan as well as Mission 3000. And I think it's a matter of implementation. So it's not a question of what, it's a question of when they will be implemented. And that is what we'll be looking at.
Okay, thank you so much. This has been a pleasure speaking and getting a great perspective as to what to expect from the railways. A bulk of the infra spend, viewers, of course, comes from the railways, and therefore it's going to be very crucial to understand how that plays out. Also, you've got so many railway counters dependent on the kind of number that the finance minister puts out on the 1st of February. But let's switch focus. Times Network's Mihir Bhatt speaks with World Economic Forum President and CEO Borge Brende on global growth, geopolitics, trade resilience, and how AI investment is shaping a cautiously optimistic economic outlook. Listen in.
Are you concerned, Borge, about, for the lack of a better word, weaponization of trade or weaponization of tariff between countries? Are you concerned about that? Because it's in direct conflict with the spirit of globalization.
Since the start of the 1990s, we have had this globalization for 30 years. It doubled the global GDP. The extreme poverty in the world went from 40% to 10%. So it gave its benefits, but they also had challenges related to it. For example, many blue-collar workers in already industrialized countries and middle class got competition from emerging economies they didn't have before. You have to look at it in a broader historic context. Trade has always been fluctuating. We have been through a period of a lot of trade and opening of borders. Now we're in a different situation where also post-COVID, countries are not only thinking about just in time, but also just in case, so they're strengthening their supply chains. And then you have on top of it this friendshoring, that some countries only want to then trade basically with what they define as friends. But that's also very complicated because, as I said, with US and China, they're already so interlinked. I think the same with the US and India are very interlinked, but that process of negotiations are still going on. And I thought by Davos that would have been solved, but let's see.
with closing trades, and in their latest report, Bernstein says that Indian markets lack momentum. ET Now Sajid spoke to Venugopal Gare, managing director at Bernstein. Listen into what he had to say over the sectors that could potentially help the market find back its growth.
No, I would say that there is an implied earnings recovery expectation built into FY27 numbers, which is this calendar year and beyond, compared to a fairly meager growth last year. So, from a perspective of not just growth, but also earnings revisions, which in our view last year would have bottomed out and started to settle at a certain level. What markets look for is not growth recovery, which is already priced in my view, but the drivers for earnings upgrades. Now, this is where, in my view, as of now, there's less visibility on what will drive earnings upgrades from here. And that's the reason why we ended up cutting India to a neutral beginning of this year with a positive returns expectations, but not a very large return expectation.
So, what is the kind of earnings growth that you are expecting for FY27?
I mean, like most others, we are building in about 12% plus growth for next year. And on a CAGR basis, my target for Nifty assumes a 13.5% EPS CAGR over the next 2 years. Because the target is based on 2-year forward EPS. Now, that's, by the way, the best case growth one can build in over the next 2 years.
So, you're building in a much better earnings growth in FY28 compared to 27.
Yes.
Can you also give us a sense of some of the data points which are there? Your report mentions about lackluster data points, which is plaguing the Indian market, and as a result of which we are seeing a lot of foreign outflows, which is happening for the last 12 to 14 months. How do you see this entire outflows? Of course, it's been supported by a strong domestic liquidity which is coming in from the mutual funds, but the valuation for the index remains at 21 times going forward, and that's been held on by the domestic flows.
Yeah, so in fact, last year was a pretty interesting policy year. We were anticipating a lot of SOPs for consumption, which is what essentially played out, which helped actually the economy recover from sub 6% growth to closer to 8% on real terms. Of course, nominal growth was lacking, but that was largely well understood over the last 12 months. But going forward, if I were to think of data points, pure macro perspective, I guess incrementally are lower. For example, even if you assume a rate cut, you can't assume a very large rate cut cycle. So we are more closer to peak of the rate cut cycle. Similarly, from a government policy standpoint, they have done a lot last year. It has led to some growth recovery, but not a substantive increase in terms of consumption spends, for example. So what can they do this year, especially when balance sheets are tight from a government standpoint? Unless they raise fiscal deficit targets, rather than keeping it on expected lines, there is no incremental growth lever expected to come from the government. And more importantly, India-US trade treaty, which is a much awaited sort of arrangement, has also got delayed a bit. We do anticipate that to get finalized this year because a lot of negotiations are going on. But only question that I have in my mind is that whether the treaty essentially holds good in terms of sustaining whatever the trade regime is discussed through the year. Will it remain volatile and keep changing through the year? So I would probably characterize it as bits and pieces of some positives, which can be eked out this year. But as of now, I'm missing that, that big swing up in terms of what can drive, the macro and earnings.
It's interesting that you spoke about what happened last year. You had the the government cutting income tax, then the RBI cutting rates, and then there's a GST cut which also came in, which helped boosting consumption. But despite these three measures, we haven't seen the impetus to the earnings growth which was expected. Do you see that coming through in 2026?
The reality is, if you were to look at the construct of how most of consensus is building in earnings growth for the next 2 years, significant part of the growth is being assumed to come from margins rather than a top line recovery. Yes, top line recovery is being built, which is volume recovery, but bulk of your earnings growth is driven through margins, and margins still appear to be more closer to the peak of cycle rather than bottom of cycle. So in that sense, I guess what needs to be a very critical variable is an overall economic growth lifting up tremendously, and that could of course come through stimulus. It could be a fiscal stimulus, which could of course have implications with respect to yields and other external factors. It could also come from significant investments in India from a FDI route, which leads to some value creation in terms of capacity creation, for example. It could also come from, potentially AI actually leading to a positive spin for India rather than a negative spin, which essentially means more opportunities for services players rather than impacting job growth. So there's a lot of things basically which are more ifs and buts for now, but from a point of view of what could be the incremental driver beyond the recovery that is already being built in by consensus.
I was looking at your report, and you are bullish on consumer discretionary, but within that basket, you have moved out of Jubilant and then taken in Titan. Can you give me a reason? Do you see much more better consumer discretionary spends coming in for Titan compared to a Jubilant Foodworks?
See, essentially, the logic is very simple that we are relatively more positive on consumption versus industrials. That is a sectoral view we established last year in January. Now that holds good, which means we are underweight industrials and we are equal weight to marginally positive on consumption areas. Within discretionary, we're not overweight. We are selectively looking at bottom up stocks here and there where we see opportunities. Not gravitating into stock specific discussion, it's essentially more a question of earnings momentum versus valuation, which is what drives our inclusion or exclusion of stocks. So the one that you mentioned has been included more in terms of relatively better valuations and growth compared to the other one. So that's the way we are playing. We're not like all buy on any of all the stocks in consumption, for example. Very specific on stocks or specific verticals.
How do you look at financials, private banks versus PSU versus NBFCs?
See, essentially, the pecking order still at this juncture is more private over PSUs on a 12-month view, while PSU aggression is slightly more in the near term. But our order broadly remains this. NBFCs have played out quite significantly last year. So probably that will be number 3 in the list.
You have the budget which is coming in, Venu, and you're seeing some kind of revenue shortfall coming in for the government. How do you see the fiscal, math panning out, given the budget is just 2 weeks away from here?
Yeah, so see, I think the government will meet the deficit target of 4.4, even if that means cutting down on various revenue expense areas, could be subsidies or capex. Revenue shortfall is the way I approach it is remember that GST cuts were not factored in the budget when the budget was announced in February last year. So to that extent, it is an incremental impact on revenue collection. Any tax buoyancy that emerges from such sort of cuts is not immediate. It takes a while, for that to start to reflect positively on the GST side, and that while could be more than a year, could be 2 years perhaps. So from that perspective, I would probably say that revenue expenses and other line items, government is going to scrutinize very carefully. So we're not in a very large fiscal push environment. We'll probably meet the fiscal deficit by cutting spends. Going forward, however, the policy pivot will be very interesting to watch because next year we don't really expect any major consumption stops because a lot has already been done last year. So it is all about consolidating whatever we've done on consumption side and to see if some push to capex can be done. So we are penciling in 10% growth for capex next year. Our only sort of push in one of the reports we wrote is that government should ideally not worry about fiscal deficit and even if they keep fiscal deficit flat or maybe slightly above for next year and focus more on directing spending and re-energizing the economy till the time private sector starts to be more aggressive on spending, that will be a better strategy than pulling back on spends.
Venu, do you see government, bringing down some bit of spending there because you still have that challenge of getting that nominal growth about 10%, and that's going to be one big challenge for the budget as well because your revenues and your tax collections are dependent on that, and if there isn't much buoyancy in tax revenues, especially after the cuts that have happened last year. What is the kind of headroom that the government has to ensure that they follow the fiscal glide path they have already, enlisted, and meet the street expectation on capex and other spendings?
There isn't much of a headroom. You rightly said, if your overall tax buoyancy is not that high, because see, all these things improve over time. We don't expect nominal to stick around the 9-10% level. It will of course eventually improve as a lot of activity levels in India improves, including on the private spending side of things. But in the interim, I guess the only way to pivot that is to ensure your pace at which you're cutting fiscal deficits, or the glide path as we call it, is moderated. uh, I would want fiscal deficits to be flat rather than be cut next year, so that there is some headroom for the government to actually spend without having to pull back on even subsidies, because that is also a very critical input for the economy. So that's where we are. It's more a 12-month thing, and remember that in another year or so, you'll have to also start budgeting meaningfully for the wage revisions. So then you are anyway stuck with that paradigm of having to budget for very large chunks, and then managing fiscal deficit is also a critical challenge. So best is to keep it high in the run up to that.
One of the biggest challenge which has been there is to get the private investments back, especially capex back. Do you see that reviving in 2026?
Reviving is a big word. Recovery probably is the right word. So we've essentially said bits and pieces of everything will happen. So you'll have a bits of revival in private sector capex as well, or rather recovery in private sector capex as well this year. See, private sector spends are purely a function of capacity utilization, which at the margin is still hovering closer to 80% or below. Private sectors are not out here to spend just like that. And more importantly, nobody likes private sector to diversify, add new capacities in new areas. So the reality is the equity market participants who actually own a lot of companies pretty much get very agitated when private sectors companies start to talk about investing. Everybody wants asset light companies, and they give higher valuations to such companies. So somewhere down the line, unless there's a need, private sector is not going to spend a lot. Private sector investments in infrastructure is an area which was a big driver for the economy after 2003 up till 2011-12. That may not return in the full, sort of a speed as we saw that time, because a lot of mistakes were made, and so banks will also not lend that aggressively to that area, and not much of project creation is happening in infrastructure, excluding power, in the private sector area. So in that sense, some part of private sector spends will still be missing. So a lot of private sector companies will still have cash, which they will either return back to investors or hold cash, whichever ways.
Finally, if there are three things that you're going to be watching the budget for, key numbers or key policy announcements, what would those be?
I think fiscal deficit number will be very critical to watch as to how they navigate, whether there's any policy read from there. The second part is, will they budget for wage bill this year itself? Because that's been an area of doubt as to whether the typical 18-month time frame post the formation of committee means, is it next year or this year? So that's the other part I'll watch. And the third thing, of course, I'll watch is capex versus subsidy, as to which direction the government is going to lead us to. These are the broader areas. I'm not really expecting any further tax cuts and other things at a personal tax level, so it's not really a watch out for me. It's always a watch out, but not something that I'm looking at closely this time.
Okay, so that's one of the many interesting conversations we have slotted for you, and the countdown to the union budget continues. We have Avinash Chandani, I beg your pardon, who is the partner at who covers agriculture for Deloitte India. He shares the expectations from this year's budget. From policy support to growth drivers for the agri sector, he lays out what to watch out for. Listen in.
The agriculture and allied sector, employing 46% of the workforce, is the foundation, the first engine of Viksit Bharat 2047 vision, with an aim to increase productivity by 1.75 times, processing levels to over 90% in food grains and 20% in horticulture. While the government continues to support the sector with various schemes having an overall budget outlay of 1.27 lakh crores in FY26, on-ground challenges do persist. As a run-up to Viksit Bharat 2047, the upcoming budget should lay a strong foundation for enabling framework. Some of the key recommendation areas, in my opinion, are capitalization of the GST rate cut-led demand with supply-side long-term investments that are required to strategically scale up infrastructure to enable farmers in the allied and agri sectors. Second, unlock FPO viability by expanding the credit guarantee fund, as FPOs find it very difficult today to access working capital because they are often not seen as a bankable entity. Third, build phygital infrastructure to operationalize agri-tech. And to do this, a two-pronged approach is required that bridges the critical gap between digital innovation and farm-level adoption by building human capital infrastructure, which is essential for a modernized Bharat.
Back to closing trades, and lots to watch out for in the market in terms of the stocks that are under pressure right now. Yes, there has been a nominal recovery from the day's low, and in fact we're somewhere around that day's highest point right now at 25,623. So the last 30 odd minutes, in fact the last 1 hour has been decent for the market. You have Interglobe that's doing well, about a 4.5% uptick coming in. Tech Mahindra, HUL today, that's lifting the spirits of the FMCG index, looking good. Kotak Mahindra Bank, Bajaj Finance, Maruti Suzuki, Shriram Finance, these are some of your Nifty gainers. But on the flip side, there's been absolutely no improvement in Wipro from the day's low. It's right there, about an 8% cut on Wipro. Reliance still lower by 3%. Tata Motors PB, Max Health, ICICI Bank, Eternal, these are some of your top losers right now. Let's get into conversation with Sunny Agrawal, the head of research of fundamental desk at SBI Cap Securities, to get a better sense of how to gauge or how to navigate the market setup right now. Sunny, hi, good afternoon, and thanks for your time. Talk to us about what the strategy of an investor should be right now, given that the markets are absolutely subdued right now, and it's actually the bigger names, the heavyweights in the market that are dragging it lower. But at the same time, there is no respite in the broader end too. How does one navigate a market like this?
Yeah, good afternoon, everyone. I think, yes, definitely a very weaker sentiment environment, very weaker sentiment as far as markets are concerned. But having said that, what I feel is that ultimately, as an investor or as a trader, our job is to identify companies which are likely to report an healthy earning growth over the period of 2 to 4 quarters, and those are the companies or list of companies where one can gradually start deploying money. I think the current pressure in the market is obviously because of a kind of a muted numbers by a few index heavyweight, and at the same time ongoing geopolitical tension is one of an overhang which is leading to an kind of persistent selling from foreign institutional investor. A case in point, I think few mid-sized banks have reported good set of numbers, whether it is a federal bank or with a very robust provisional update from a Catholic Syrian bank. So I think again within each and every sector there are few names which are likely to do well in terms of earning growth. And as we speak, what we feel is that auto and auto ancillary as a sector is relatively well placed, where we have seen a very strong December quarter in terms of volume growth. And at the same time, if you look at an outlook by CM, which is an industry association, since FY27 is also likely to be very robust for auto OEM industry. So I think overall beneficiary will be an auto ancillary. And we have seen a decent correction in the many auto ancillary name, case in point, Bellrise Industry, or for that matter, Precall. So a good quality auto ancillary is then a place to be in if somebody want to invest from a period of 6 to 12 months.
Sunny, this new IPO, Bharat Coking Coal, how do you look at it? Did you expect the kind of move that it gave today?
No, again, I think one of the reasons for a very robust listing can be a very low price, wherein a low double-digit kind of price usually tends to attract many retail investors. And at the same time, valuations were also comfortable at the time of issue. So we have seen that at the time of issue, the valuation were closer to 6.5 times EV to EBITDA. as compared to an peer companies which are trading closer to 10 to 12 times EV EBITDA. Now, after post-listing, it seems that even the valuations are closer to its peers, and obviously third is an low float in the stock. So I think only 35% was reserved for retail, and again the issue size was on a smaller side, 1,000 crore issue size. So I think all these factors lead to a very robust listing in Bharat Coking Coal. Henceforth, we feel that ultimately it's a proxy play on growth of the steel industry. And accordingly, depending on the growth of steel industry, we will see the demand of coking coal will continue to go up. So I think if somebody has invested in IPO looking at an listing in, maybe it's the right time to book the profit. And long-term investor can expect closer to 12 to 14% kind of CAGR return from here on.
Okay, so that's a strategy that one should have on Bharat Coking Coal, especially after such a bumper listing that it's seen. That stock is up by about 75% on listing day gains, of course. And on that note, viewers, time to slip into a very short break. On the other side, we're going to be addressing the earnings of Hindustan Zinc. The flashes on your bottom of the screen. Prima facie looking like a good set of numbers coming in, and the stock price is also reflecting that, about a 2.5% uptick. A deeper dive on this on the other side of the short break.
Output at record. Steel below 1 billion tons. Chinese aluminium output rose to an
While we are on the topic of commodities and talking about silver, let's just once again reflect on the numbers that have come in from Hindustan Zinc. Very strong set of numbers coming in from the company. The consolidated revenue has come in at 10,980 crore rupees, much higher, about 900 crore rupees higher than what the consensus estimate was of about 10,000 crore rupees. The EBITDA has come in at 6,054 crore rupees, higher than the 5,600 amount that we were expecting. Similarly, for net profit is coming at 3,916 crores. The estimate was only 3,500 crores, so another big beat over there. Margin estimate was 54.8%, and the margin has come in at 55.1%. So looking very good for Hindustan Zinc. You can see that the stock price, there's been a sharp spike since a few minutes ago when the numbers came out. 4% higher, in fact 4.25% higher for Hindustan Zinc right now. What really stands out is their silver segment revenue. If you take a look at this year's number, it's at 2,676 1,486 crores compared to last year where it was 1,464. So it's an uptick of about 83% on a year-on-year basis on silver alone. So that is something that looks very good. And in fact, even in the previous quarter, in quarter 2, if you want to compare the numbers sequentially, this number was just at 1707. So again, a very big jump coming in on a sequential basis too. That's about 57% jump on a sequential basis. So Harsh, these numbers are looking very good, and of course it's been silver all the way for Hindustan Zinc. The rally that we've seen in silver prices, yet again another 5% uptick just today on silver. And of course, remember, Hindustan Zinc derives about 35 to 40% of its revenue from the silver segment. So looking very good for these numbers, Harsh, today.
Clearly, the spike on the stock also visible, 4% higher on the stock price of Hindustan Zinc. And I wonder what the estimates with regard to silver are where Hindustan Zinc's forward-looking estimates are concerned, because now at $93 a barrel, or the peak at $93 a barrel, I would reckon it is substantially higher than what analysts have penciled in their estimates. So that's something you want to look out for as well. But clearly the numbers are a beat, 10% beat on profitability itself, very, very visible. Let's in fact switch focus. We also have the IMF, plenty happening all together, and the IMF has raised the India FY26 growth outlook. IMF cites strong October to December momentum, and the India outlook for FY27 also will likely ease as a result. Also something to mark out, China's GDP growth forecast for 2026 has been increased by 30 bips by the IMF. They've also raised US GDP forecast by 30 bips. US will now, according to the IMF, grow at 2.4% for calendar year 2026. So looking very good. Global GDP forecast also hiked by 20 bips, so 3.3% as the revised forecast post the 20 bip hike that the IMF has taken. India growth will likely ease in FY27. Cyclical temporary factors will start to wane, is what the IMF says. But they've raised the FY26 forecast on strong momentum. So that's of course on IMF. But sticking with metals, and we spoke about Hindustan Zinc. From raw alumina to molten metal, aluminium production is a complex, energy-intensive process. Nalco's smelter sits at the heart of this with a capacity of over 4.6 lakh tons per annum. This facility powers both domestic demand and exports. As India pushes manufacturing and infrastructure, Ankur Mishra takes you inside the plant to see how aluminium is made and why this metal is critical to India's growth story.
We are at the Angul plant of Nalco, where the smelting is being done, and you can see the casting chamber 1 is functional here, where the molten form of aluminium is being converted into various products. Now, which are these products? These products are standard ingot, which is the standard size we have been told is 22.5 kg, and there are other kind of ingot too, which is alloy ingot, T ingot. Overall, the smelter capacity at Angul is 4.6 lakh tons per annum, and alumina is converted into primary aluminium through electrolytic reduction. The molten form of aluminium is routed from the pots, and there are two divisions majorly. One is the casting units for ingots, SAW ingots, T ingots, and other one is rolling products units for rolled products and aluminium strips. Now, aluminium products are sold domestically and also exported, and exports are routed through Kolkata, Paradeep, Vizag port. The salient features and technology includes overall, if you talk about 180 kiloampere cell technology is being used in these products, but more importantly, let's talk about the capacity. The capacity is 4.6 lakhs tons per annum. And what is the plan of the company? The company aims to double the capacity. When it is happening, it is likely to happen in next 4 to 5 years, we have been told. And the idea is to move towards doubling of capacity from this particular plant. Why so? Because company wants to become Maharatna, and smelter plant will contribute into it.
Budget is round the corner. We'll see 1st of Feb, Finance Minister will present the budget. What are your expectations from the budget this time?
Our expectation is there will be a good amount of spending in infra, and the power sector also, because when the infra is growing, the power sector will also grow. These are the two sectors, because as far as aluminum consumption is concerned, 40% of aluminum goes in the power sector, 10 to 12% in infra, and maybe 6 to 7% in EV. So last reduction in GST rates,
Right.
that has led to the boost in the vehicle sector, and the EV sectors are coming. So that has also led to the increase in the consumption. So from this budget, we are very much hopeful there will be good amount of spending in infra, because India is going to increase, the GDP of India is going to increase, and we are one of the fastest growing economy. And the kind of consumption of aluminium is directly related to the growth of GDP. If the growth of GDP is 7%, 6 to 7%, the aluminium requirement will be 1.5% times the growth of the GDP. So it is, we know that India is a growing economy, and from this budget, we are very much sure there will be huge expenditure on infra.
Okay, all right. So that's of course coming from NALCO. Now, Kunal, within the metals pack, something that excites you, something that looks good on charts?
I think most of them. I think whether you look at large cap names like Tata Steel, mid cap odd names like Jindal Steel, I think all of these stocks are looking quite ripe for a further continuation up move. It's just that these stocks have a tendency of taking a pause in between and then try to regather the momentum for themselves. So I think in that context, you'll have to wait out for those points where the stocks go into an odd day for mild correction, a mild reversal towards the 20-day moving average, or the 10-day moving average for these stocks, depending on how far these stocks have rallied up higher. But what we are looking at is a major cyclical up move for many of these metal names, and the rally which started off, I think, in the second half of 2025. I think from there we've just started maybe one phase where many of these stocks have come back to their previous lifetime high levels, and then I think in the second leg of an up move, I would expect maybe a broadly 10% to 15% rally further for many of these metal counters from current levels. So bullish on most of the counters: Tata Steel, Vedanta, SAIL, Jindal Steel, even Hindalco. I think to a larger extent, I would probably be bullish on these stocks for a potential 10 to 15% upside for the next 3 to 6 months.
Okay, so looking good over there. Sunny, I want to talk to you about Hindustan Zinc's numbers, particularly while we're talking about metals. Just give us an overview of where you think silver as a precious metal is headed from here, because we've seen massive spikes. Just today morning, we've seen a very massive spike coming in on silver yet again. And a lot of Hindustan Zinc's revenue is contributed to by silver. Where do you see silver going now? Do you believe that this rally has more legs to it, or do you believe it's time for a little bit of a pause on the run-up that we've seen in silver?
Very exponential rise on silver prices, and that is also getting reflected in Hindustan Zinc number. So I remember during the September quarter, I think the average realization for silver was closer to $50 to an ounce for an Hindustan Zinc. I am unable to access the price release right now. I am sure the realization during this quarter would have been far lower than the current realization, which is going in the north of $90 to an ounce. So I think Hindustan Zinc, wherein last time also they have guided that maybe they can exceed on an annual basis 700 to 750 kind of ton production on a full year basis. And even during the last quarter, the total contribution from silver to the profitability was closer to 40%. So I think silver seems to be a clear-cut growth driver in terms of earnings for Hindustan Zinc. On silver prices seems to be I think there is fundamentally nothing has changed as such that in the span of 2-3 months, the demand of silver has actual ground demand has gone up by 2x or 3x. Obviously, the supply restriction by China and to some extent maybe some speculative activity would have led to such a sharp spike in silver prices, but on ground demand continue to remain the same. So maybe hoarding is something which is one of the key reasons for silver to move up. Maybe correction is something which can happen anytime soon as far as silver prices are concerned. So I think maybe time to remain cautious on silver prices on commodity side.
Okay, interesting. Sunny, your one big idea for 2026?
So again, coming to an idea, I would like to stick to an auto major. So one OEM name, TVS Motor. So we feel two-wheeler and three-wheeler as a category will continue to do well. So which is, so TVS has got a presence across the all the category of two-wheeler as well as three-wheeler. So TVS Motor among the large cap name, and another proxy play to an two-wheeler is the Precall industry. So Precall industry where we have got a active coverage on. So we believe the fair value of the company is closer to 850 rupees, wherein they are a market leader in terms of driver information system and fluid management control system. Recently, they have ventured into a disc brake, which is likely to be a mandatory product beginning this year. And in addition to that, they have recently acquired plastic molded business in organic acquisition. So I think the new products will drive the earning growth for Precall going forward. So Precall from a mid-size auto EM, auto ancillary play, and TVS Motor from an auto EM.
Okay, so that's the take on what stocks are looking good right now. Kunal, talk to us about a chart check on Jindal SAW. Look at that stock, 16.5% uptick coming in on that one today. A couple others like CG Power that we were talking in the morning still continue to hold bright, but Jindal SAW, Kunal, very solid move today.
It's a strong move, excellent volumes for the stock, talking almost 11.5 crore in terms of the volumes on the NSE for the stock today, which is by far, I think, one of the highest volumes the stock has seen, I think, in the last 2 or 3 years on a single day as such. This could also probably indicate that the stock could probably have ended a major phase of a price correction, because in 2024, the stock was almost at 375 to 380 levels, and from there the stock had halved. So it's corrected towards 166, 170 mark, where 155 mark rather in the last couple of weeks. So I think in that sense, the major part of the correction now seems to be behind. And with this kind of a stronger volume price action, I would probably expect that we are looking at a potential turnaround for the stock in the medium to long term. So could be a good buy and dips candidate from current levels, as well as towards dip around 165 to 170 range.
Okay, so that's on Jindal SAW. The SAT, which is the Securities Appellate Tribunal, is set to hear Jane Street's appeal against SEBI's interim order on February the 25th. The case listed before the SAT Mumbai bench today stems from SEBI's July order alleging manipulation in index derivatives, an investigation that regulators say could widen further. My colleague Anurag Joshi is tracking this closely and joins us with more details.
The Securities Appellate Tribunal will hear Jane Street's appeal in the Securities and Exchange Board of India's interim order on February 25. The matter was listed in SAT Mumbai bench's cause list for today. On July 3rd, SEBI interim order accused Jane Street of market manipulation in Indian derivatives. In September, SAT had ordered SEBI to reply within a period of 3 weeks on the Jane Street matter. And in a subsequent hearing before SAT, SEBI has said that its probe and the final order on the Jane Street matter could be wider. Jane Street, on its side, had requested the release of all documents with SEBI that are relevant to the case. SEBI sources had said in July that the interim order had looked at 18 key days of Bank Nifty index manipulation, as they put it. And the period probe for the SEBI interim order was on the expiry date from January 2023 to March 2025. According to SEBI sources, at that time, 90% of the retail trade in index options on the expiry day lose money. And a separate SEBI study had found that Indian retail investors lost about $12 billion trading in equity derivatives in the financial year to March 2025.
Okay, thank you so much for that, Anurag. Let me come back to you, Kunal, with regard to PNB. Now, in terms of the stock price action today, we've seen a bit of a correction on the price. I'm trying to understand whether this is a good opportunity to buy.
Well, it may not be a good opportunity to buy the full quantity at current levels, but yeah, I think it definitely offers a scope that the stock is getting ready for a mild correction or a mean reversion. In the last 4 or 5 days, PNB was moving from that 120 to 135 kind of a band, and that too at a point where the benchmark indices, the Bank Nifty, was seeing a lot of pressure. So to try and come back towards mean reversion of sorts for PNB, I think it could start to throw a good opportunity. I would believe closer to 120 to 125 range is a good range for PNB, for traders who buy PNB on a contra basis, because that's where I would believe that the risk reward will start to look very attractive. Largely, the PSU banking stocks still look extremely positive on a medium to long term charts.
Okay, all right. So that's the take coming in. Sunny, some of the smaller private sector banks also came out with numbers. The likes of a Federal Bank, an RBL Bank, a Yes Bank, anything that stood out for you from within that cohort?
I think Federal Bank numbers were pretty decent, and what we have seen that post management change, there is a gradual recovery across all the key operational metric, and I think it seems now the bank is well placed to ride the growth momentum of an industry wherein the credit growth for the entire industry is likely to be in the band of 11 to 12% for FY27, and at the same time, NIM for most of the banking players seems to be bottoming out. So it seems that Federal Bank, even at a current market price, despite of rally, seems to be a reasonably well placed. We feel the fair value of the bank is closer to 320, 330 rupees. Keeping that price target in mind, one can approach Federal Bank.
Okay, all right. So that's with regard to Federal Bank. What's the upside like, Sunny, with regard to a Federal Bank?
So we believe the fair value of the Federal Bank, keeping in mind the investment horizon of 12 to 15 months, is 320 to 330 rupees. So keeping that price target in mind, one can approach invest in Federal Bank.
Got it. Okay, perfect. All right. With regard to the power space, you had the likes of an Atlanta Electricals come out with numbers. Stock spiked. We've seen a cool off after that. We had the likes of a BHEL also come out with numbers. Sunny, how do you evaluate those numbers? BHEL, in fact, not accounting for the new labor code adjustment which they need to make. Do you believe that knock will likely reflect in Q4, and as a result, margins will shrink further because they've shrunk from 8% to 6% this time?
The overhang of increase in Chinese competition is something which is also one of a key parameter which Street is looking forward to. And anyway, if you look at overall BHEL, even in terms of valuation, we find the valuation to be very expensive. So right now, as we speak, the market cap of the company is closer to 92,000 crore, and the annual profit generating potential of the company is closer to maybe 900 to 1,000 crore number. So trading at closer to 90 times price to earning multiple. So even if the company continue to report a decent growth in FY27, we feel the valuations are pretty expensive. Instead of BHEL would like to invest in Larsen and Toubro, which is a peer to BHEL, and again a well diversified portfolio. So there the risk reward seems to be better favorable as compared to BHEL.
Interesting. What's your take, Kunal, with regard to L&T on charts?
See, I think for the first time in the last, 6-7 days odd, it looks like that L&T is seeing some bit of demand at lower levels. 38.50, 38.40 is where the stock has made an intraday low, and from there the stock is bouncing back. So it looks like that this 3,800-ish odd mark for L&T could act as a decent support for the stock price. Maybe if we get one more leg of confirmation, say a good close tomorrow, that will be a confirmation signal for the stock price over the near term, where we may expect a bottom formation to happen. But I would also believe that I think stocks like L&T hardly go into that phase of a 10% to 15% correction, and we've seen that historically, that whenever those opportunities have been thrown by the stock price, it's actually been a very good opportunity for long-term investors to try and chip into and take advantage of that correction. So I believe L&T in that aspect also looks to be a very attractive chart, specifically from a long-term play.
Okay, so that's with regard to an L&T. Let's go across. In fact, we're just a couple of minutes from close. Sunny, thank you so much for joining us. We'll let you go on that note, and we'll go across to Snehi as well, who's here with the roundup of the day. Snehi, over to you.
Well, yes, absolutely lackluster day of trade coming in for the street. At one point, we were above the 25,600 mark, and it was starting to look slightly optimistic for us, but it's reversed entirely from there, and we're back now struggling to hold on to that 25,550 mark, and slightly more than 0.5% cut is what we're seeing on the Nifty today. Sensex to a similar 0.5% cut coming in, and Nifty Bank also absolutely in tandem, a 0.5% cut over there. The advanced decline ratio is about 1:3 right now in favor of the declines, and looking very unhealthy for the breadth of the market too right now, because the Nifty mid-cap index is lower by about 0.5% in tandem with the rest of the market, but you have the small-cap index that's seeing a cut of about 1%. Let's take you through some of the top Nifty gainers and losers. Interglobe is up 4.5%, Tech Mahindra, HUL, Maruti Suzuki, Bajaj Finance, Kotak Mahindra Bank are some of your top Nifty gainers. On the flip side, what's not doing well at all and is continuing to stay at the day's lowest point is Wipro, about an 8% cut on Wipro. Reliance is lower by 3.25%. Tata Motors, PB, Eternal, Max Health, ICICI Bank, these are some of your top Nifty losers. Sectorally, it's only the FMCG pack that's in the green, with auto being on the flat line, but it's names like Colgate, HUL, ITC that have done well. On the flip side, Realty continues to be the top sectoral loser. Godrej Properties seeing a 5% cut in trade today. Brigade, Signature, Lodha, Sobha, Anantraj, DLF are some of your top losers. So barring FMCG and auto, there's pressure on PSU banks, pharma, IT, energy, and of course Realty taking the biggest knock. Let's talk about some stocks that are in focus on the back of earnings. Jindal saw sequential numbers were good, 15.5% uptick on that stock. We've got numbers from JSW Infra and Brokerage. Thumbs up coming in over there as well. It's IRFC, BHEL, Hindustan Zinc, PNB. Lots of numbers to watch out for that have trickled in the second half of the trading session. But that is how we're winding down on the day, with massive cuts on Wipro, RBL Bank, IDBI Bank, MRPL, now that they've stopped importing Russian crude oil, HPL Engineering, Jubilant Pharmova, Godrej Properties. These are some of your top losers in trade. But with that, Harsh, it's back to you in the studio.
Okay, thank you so much for that, Snehi. Kunal, what do you make of the day, and what do you make of some of the IT names? Because it's been a divergent day for constituents of the Nifty IT. One, there's a Wipro, which has seen a significant cut, and then you have Tech Mahindra on the other side. How do you look at it?
Yeah, so I think we've been meeting this point that TechM, HCL Tech are the two ones which have been very strong relatively. Then comes in the likes of Wipro, Infosys, specifically after last week's price action. I think were the ones which have been doing fairly well for themselves on a relative strength basis. They are the ones which are looking strong. So now it looks like that maybe Wipro could take some bit of more time to try and come back into a corrective phase, and it could behave more or less like how TCS did pre-result as well as post-result, where the stock went through a drag and a consistent bout of a very mild correction over the short term. So, but the view on the IT index as such still remains to be on the positive side. Yes, there's been a lot of chop and churn within the IT pack. Few large cap names which have found favor. The likes of TechM and HCL Tech, for example, have still found the momentum to be sustainable and positive. But for the other ones where the move was a little bit more high beta, you've seen these stocks coming back into a mean reversion phase. So that's the chop and churn which happens on a regular basis for sectors. But the view on the large cap IT names as well as the IT stocks as such remains to be on the positive side.
And the market move today?
Yeah, it's disappointing to see the index close on the lower side after a good intraday recovery. My only sense was that maybe I think we could be looking at a close just around the 25,600 mark. But the way the markets have given the gains in the last half an hour indicates that we may be in for some sort of a test towards 25,500 mark on the Nifty. So the most important support which we are looking out for is 25,500, from where we've bounced twice in the last 4-5 trading sessions, and we've managed to see some good recovery on an intraday basis. So I think this could be potentially the third attempt where the index could make at the 25,500 mark.
Okay, thank you so much, Kunal. We'll let you go on that note as well. And viewers, completely out of time on this edition of Closing Trades. From Snehi, myself, everyone who puts this